Hello and welcome to this Bitesize Technical video on the taxation of pension payments. When a member takes pension benefits, typically 25% of the amount crystallised will be tax-free and any payments from the remaining amount will be liable for income tax. Income from pensions, whether received through a lifetime annuity, a scheme pension or through drawdown, is taxable. The pension provider must deduct income tax through the PAYE system using the tax code provided by HMRC to calculate the amount of tax due. This can sometimes lead to an overtaxation, as until the scheme administrator has the current year tax code for the member, under HMRC rules they have to use either the current year P45 code, if available, or an emergency tax code, but both of these must be applied on a month one basis. For those taking a regular stream of income, HMRC should automatically adjust their tax code after the first payment, so they receive the right amount in subsequent months. But where an individual is making a single withdrawal in the tax year, the system is likely to lead to an overpayment of tax. The month one basis means that if someone takes an income payment, that they only receive 1/12 of their personal allowance, leading to a much higher amount of tax deducted than they would have been expecting. This applies regardless when in the tax year the payment is made. For example, if someone makes a pension withdrawal of £12,500, i.e. under the personal allowance, and has no other taxable income, they might expect for it to be completely tax-free. However, because of month one is applied, their tax allowance is divided by 12. This means only £1,048 will be tax-free, with £3,141 charged at the 20% basic rate and the balance charged at the 40% higher rate, meaning a tax bill of around £3,950. If they take no further payments in the tax year and no other action after being overtaxed, HMRC will correct the position at the end of the tax year as part of the normal PAYE process by sending a P800 tax calculation and refunding any overpayments. There's also a process to reclaim any overpayment within the tax year by completing and submitting the appropriate form to HMRC. The form required depends on the circumstances. If the pension fund has been emptied but the individual has other PAYE income, including from a different pension, then form P53Z is required. Where there is no other such income, it's form P50Z. Where the pension has not been completely emptied but there are no further withdrawals to be made in the tax year, then it's form P55. Once HMRC have received the correctly completed form, they should repay the refund within 30 days. Another option is for the individual to withdraw a small initial income amount. This will prompt HMRC to provide the correct tax code for the scheme administrator to use going forward. The initial payment will be overtaxed, but any subsequent income payments will be taxed at the appropriate rate rather than on a month one basis.